relevant life plan. Yeah, a relevant life plan, executive income protection, private medical insurance, buy-to-let, etc. Yeah. So now coming to the pension, which is the most important thing, why we do pensions through the company. Because anything that the company contributes towards your pension is corporation tax deductible straight away. So Said will reduce your corporation tax liability on one hand, and on the other hand, you build up your own pension pot. Yeah. So if the advantage of private pension is flexibility of the pot, basically, which means there's no set amount. It's not like your NHS pension. In NHS pension, if you're earning a certain amount, if you're PAYE, you are forced to pay like 13.5% regardless. In a private pension, which is done through the company, you don't have such requirement. You can choose how much ever you want. It's very flexible. And you can also start, stop, freeze anytime you want. For example, you run a limited company now. The company contributes towards your pension. So let's say 5 years, 10 years down the line, you wind up the company, your private pension will still continue. The pension will not stop. The pension will continue to grow, even if the company ceases to exist. Yeah, that's one. And another important benefit is you can start accessing the pension from the age of 55 onwards. Yeah, that's government is looking to increase it to 57. It's not confirmed yet, though. So if you look at NHS pension retirement age at the moment is around 68 or 69. You can't touch it until you're 68, 69. By having a private pension, that gives you the flexibility to start accessing the pension from 55 onwards. So a lot of doctors and dentists, what they do is they build up a private pension pot. So they start accessing the pension from 55 so that they can slowly wind down. So they work like 4 days a week. Then when they're in the 60s, they reduce it to 3 days a week, 2 days a week, so that you don't need to stress yourself out working until 70, until you get your NHS pension. So that's one of the flexibility which it's available with a private pension. Yeah. And the whole pension pot is held in a trust, which is basically it protects the whole pension from inheritance tax. What it means to you is, let's say you built up £1 million in a private pension, the whole £1 million is ring-fenced against any inheritance tax. So in the event of death, that pot is passed on to the beneficiaries without them having to pay any inheritance tax on that. That's the biggest advantage, because when in the event of death, everything is added up for inheritance tax purpose. Yeah, like your property, your bank balance, your buy-to-lets, everything. The only thing that sits outside inheritance is your pension. So that gives you a good way to protect the money from inheritance tax. And also the funds within the pension grows absolutely without any capital gains tax or any income tax. So the pension pot tends to grow much, much quicker than any other investments. Yeah. And another last advantage is flexibility of pension in retirement. See, when it comes to NHS pension, what happens is when you retire, NHS will tell you, okay, you're retiring at so-and-so age, you're getting a pension of X amount. So you can't change it. You can't vary that. Even if you don't need that money, you're forced to take that. Whereas in your personal pension, you don't have that sort of restriction. You can decide how much ever you want. So for example, initially you might decide to take 50,000, yeah? Maybe later when you're in your 70s or whatever, you may not need 50,000. You can reduce it to 20,000. I mean, you can draw whichever way you want. So that flexibility is available in retirement. Yeah. So these are the basic benefits of why people do pensions through the limited company. Of course, I have to talk to you about the downside as well. The downside is pension is for a longer term. Yeah, that's why the government wants to encourage people to put more money into the pension pot. That's why they give you all this tax reliefs and all that. You can't touch that until age of 55. Once the pot money goes into the pension pot, you can't take it out. So for that reason, most of my clients, they tend to do a regular monthly contribution rather than annual contribution. So whatever's doable, like £500 a month or £1,000 a month. So gradually that pot builds up. At the end of every tax year, we see if your company's got enough surplus funds, you can just do it as one ad hoc lump sum so that you make sure that you use as much as possible into your pension pot so the company doesn't pay too much tax on that. Okay? So that's briefly about the pension. So if you guys are interested, then what I do is, when I prepare a personalized illustration based on your circumstances, your age, etc., that will give you actual projection. So it'll tell you, okay, for example, you're 40 now, so you're looking to retire at the age of 60. If you were to put £500 a month in the pension, how much your pot size looks like when you're 60, and over the next 20 years, how much of your corporation tax you would have saved, etc., etc. That will show you your personalized illustration to demonstrate what sort of tax relief you'll be benefited by and how much of the pension you'll be building up over a period of time. Yeah. Said, any question from your side as an accountant, from your perspective, or anything?
No, there's one person who's asked a question, and the question that they've asked me to ask you is, what happens in the event of death with the pension pot?
Okay, that's a very good question. So what happens in the event of death is, HMRC rules is like, if a member dies before the age of 75, whatever amount is built up goes to your beneficiary with zero tax. Yeah. So even if you built up £1 million, the whole £1 million is passed on to the beneficiary without any tax liability to them. So every single penny belongs to you. And also, unlike NHS pension, you don't have any restriction on who the beneficiary should be. It doesn't necessarily have to be just a spouse and children. You can nominate your brothers, sisters, friends, uncles, aunties, whoever you want, and you can have multiple beneficiaries. Yeah, does that answer the question on with regards to death benefit? And what happens, another thing is, when we hold the pension in a trust, there is a reason behind it, why the money is held in a trust. For example, I'll tell you, if you build up £1 million into your pension trust, yeah, God forbid you're not there, if you nominated your 17-year-old child as a beneficiary, so the trustees might decide, you might have a trustee there. They decide like it's not a good idea for a 17-year-old to have access to 1 million quid. So what we'll do is, the trustees and St. James's Place, we'll take a call and say, okay, we'll give them a monthly payment of whatever amount is reasonable. And once the child reaches a certain age, then we pass on the whole wealth to them. So the trust gives that flexibility for the trustees to do, rather than the moment you're a beneficiary, it's not as if the whole amount immediately goes to the beneficiary. Does it make sense? Yeah.
Shabeer, we've got two questions here. One is, someone's asked a question, and she's on here at the moment, about age of starting the pension. Say if they are 50 plus, what actually happens? And the second question is, what happens if the company closes down?
Yeah, so you can start the pension at any age. There's no restriction. I mean, of course, you can't contribute after 75 as per HMRC rules. Even if you're 50, you can start the pension. However, the amount of money you build up will be much less compared to somebody starting in their 30s. You know what I mean? Because there's not many years left for retirement, but there's no restriction as such. You can do it. And then if your company closes down, whatever the company is invested into the pension, that pot will still continue to grow. And that you have same access. Even if you're not the director of the company, you can still have access. In the event of your death, your beneficiaries, whoever, they still have access to that. They're two separate things. Your pension pot is personal, it belongs to you, yeah? And while the company is contributing, the company is saving on corporation tax. Does it make sense? Yeah?
Yeah, one further question. The question is, two further questions actually. What happens if someone dies after 75?
Yeah, that's a good question.
And the next question is similar. Can you help in setting up somebody's benefits for other employees, current and the future?
Okay, first question I'll answer, 75, yeah? So basically, you can start accessing from 55 onwards, right? So if you reach 75 and you haven't touched your pension pot at all, and if the member dies, the money will still go to the beneficiaries. However, the beneficiaries will have to pay tax at their marginal rate, depending on whatever the tax bracket is. they won't get the full amount tax-free. So that's why what we recommend is once a person reaches like 70s or late 60s, we'll ask them to start accessing the pot. I mean, there's no hard and fast rule that you should access it, but if a person's got other sources of income, they don't want to touch the pension pot, they can leave it as such, and that will go to the next generation. Possibly if their children or grandchildren can make use of that pension. Yeah, it's there. And sorry, what's the next question you said, Said?
Okay, the next question was, can you help in setting up some of these benefits for other employees, current and in the future, via the company as a perk?
Yeah, if you have employees apart from you as a director, if you got other employees, yes, we can set up a pension for the employees as well, and the company will pay towards their pension and save corporation tax on that. This is predominantly what happens is for doctors and dentists who are like one-man band sort of thing. They run the limited company. Their income is outside IR35. They do it. But in some cases, they do have employees. Sometimes what happens, they employ their spouses as well as second director of the company. And company can still contribute towards their pension. Like they can have the salaries. They can also have life cover, and they can also have pension. All that will go towards reduction of corporation tax.
Okay, that makes sense. One final question on this topic is, what happens if you sell the company or the director steps down?
The director steps down, or when they sell the company, whatever money is gone into the director's pension will still remain there. That's got nothing to do with the company. Even if the company completely closed down, it will still, the pension won't get affected as such. And it's independent of state pension, by the way. Yeah. So I don't know how much you guys know about state pension. All of us get state pension when you reach state pension age of, I think now it's around 67 or so, 66, 67. For you to be eligible for state pension, you should have contributed national insurance for 35 years from the time. So if you reach your state pension and you have not contributed 35 years of national insurance, you will still get state pension on a pro rata basis, depending on how many ever years of state pension you contributed for. At the moment, approximately about 12,000 per annum is the state pension per person. And state pension is also taxable. When it comes to pension access, what happens is, if you build up a pot, let's say you made a pot of £1 million and you retire, what HMRC does, it allows you to access 25% of that pot is tax-free. You can take out the 25% without having to pay tax. The remaining 75%, you pay tax depending on what your tax bracket is at that point in time. If you're a basic rate taxpayer, you pay 20% tax. If you're a high rate taxpayer, you pay 40% tax, depending on whatever situation is at that point in time. That's on the taxation side of things, yeah? And any other questions there, Said?
One more question. What happens if there are more than one directors? Who gets the money? Yes.
If there are more than one directors, you can set up a pension for each of the directors.
Absolutely.
Each of them can have their own separate, because pension is an individual, like an individual account. Director A will have his or her own pension pot. B will have their own pension pot. If one of them die, their pension pot will go to their beneficiaries, depending on whoever the beneficiary. That got nothing to do with the company. It won't be passed on to the surviving directors.
Yeah. One final question, Shabeer, is if the director doesn't take salary from the company, can the company still give can the company still give pension to the director? Yeah.
Correct. If as long as they draw something, as long as they draw some dividends, and basically you do this wholly and exclusively criteria, right? As long as you know it's for the business, it's allowed.
Yeah.
Where the HMRC can challenge you is if, let's say, for example, the company made a profit of 40,000 and you want to put 50,000 into a pension, they can come and challenge you. Or if you put exactly the same amount, they might come back and ask. If it's reasonable, that's fine. If a company made 50,000 profit and wants to put 30,000 into a pension, it's still doable. So if you have multiple directors, all of them can put money into the pension pot. There's no restriction whatsoever on that side of things.
Okay, that's fine. That's it. Let's move on. Okay.
Perfect. Yeah. So I'm not sure if any of them have experience in investment. So basically what happens when you put money into a pension pot, that money gets invested. We invest in various markets, European market, American, emerging markets, etc. Yeah. So that gives you a sustainable return over a period of time. Like, for example, our funds on a longer term have given return of average of 10 to 12% per annum, net of charges. So this chart basically tells you compared to all types of assets, investments have always yielded much better return than compared to rest. Because it can be volatile sometimes. If you see all these dips, blue dips here and there, that's basically due to, for example, the biggest dip here is due to COVID. But you can see that within 6 to 8 months, it picked up and went back to normal. Yeah. So despite volatility, investments always tend to give a decent return over a period of time. So the whole idea is not just to save corporation tax. The whole idea is to build up a pot over a period of time. So the last thing you want to do is if you invested 100,000, you don't want to see 100,000 after 20 years. Obviously, it has to grow. So that's the growth we're looking at. Yeah. And why St. James's Place? So basically, I'm a partner of St. James's Place. One is St. James's Place is one of the big wealth management companies in the UK, as far as the company is concerned. And expertise-wise, I have more than 20 years experience in financial advice. So my job is, it's not just transactional. Look at the holistic side of things, looking at your company's profile, your personal information, etc., to give you the best advice. And we sit down like every 3 months, 6 months, or every year, depending on how much time you want to sit down with me. So we discuss. And the whole idea is to grow wealth tax efficiently and how to pass on that wealth to the next generation in a tax efficient manner. So we look at one generation up and one generation down to make sure everything we do, it's done in a proper manner, because we are, end of the day, we are regulated by Financial Conduct Authority. So I have to make sure that everything is done. Yeah. And you have this SJP guarantee. What it means to SJP guarantee is, for example, if I give you an advice, maybe 5 years, 10 years, 20 years down the line, that advice is construed as a wrong advice, St. James's Place guarantees to make good the financial loss. You must have heard in the newspapers in the past year, there are many dodgy companies and dodgy advisors have sort of given all bad advice to people, and people have lost hundreds and thousands of pounds in pension. So that's the reason why FCA has got all these checks and balances. And as St. James's Place gone one step ahead, so they give that guarantee as well. So for our clients, they have the peace of mind that, okay, even though I'm going with this guy, even if something goes horribly wrong in the future, I know that my money is safe as well. And ongoing advice. So we look after you not only on the pension side of things. I look at pensions, for example, if you have things like mortgages, protection, all of that is covered in this advice, not just pension alone. And one of the most important things I want to tell you is, for all of us, we'll be concerned about the security of the money, isn't it? Building up £500,000 is a good thing, maybe 20 years down the line. So we'll all have that concern, right? Or what happens if this company goes belly up tomorrow? So because even though I'm a partner advisor of St. James's Place, even my pensions investments are with St. James's Place. So it's a valid question for a lot of people. So what happens if I build up a pot of £500,000 and tomorrow St. James's Place goes into administration, what will happen to our money? So when it comes to protection, there are 2 layers of protection available. Yeah, one is the government protection. So there's something called the pensions regulator. They monitor all the pensions in the UK. So they protect everybody's pension up to 90%. Even if the company goes into administration, they will protect 90% of your pot, right? What St. James's Place has done is they have gone one step ahead, and all the investment that we have, as we speak, SJP holds, we manage funds up to £179 billion as of now. Yeah, we mean like your funds. We have £179 billion. Obviously, people will have concern if so much money this company is handling. What happens if this company goes belly up, like Lehman Brothers or Enron or whatever. So what happens, all the client money is held in a trust in America. So even in the worst case scenario, if SJP goes into administration, the creditors don't have access to any of the client money. They can only have access to their properties, furniture, and all that bits and bobs. But our money will be ring-fenced against creditors, and that will be passed on to the customers accordingly. So that sort of piece, I mean, most big wealth management companies have done that now. After the fall of Lehman Brothers thing, they have to make sure that they give that assurance to the customers. Even, for example, I'll be concerned as well. I mean, after saving for so long, if something happens, I have to make sure that my money is not affected. So that answers basically, it covers your security-wise, you're covered. Like I said, you have two layers of security. One is from the pensions regulator from the UK, and also money is held in a trust that protects you guys as well. So any other question? Let me just check. Is the trust holding 10%? Stephanie's asked this question. No, the whole amount, the 100% of your pension is held in a... No. Okay, you're talking about your funds. No. The trust which SJP has, it holds full 100% of the your pension pot. So if this company goes into administration, you will get, for example, the pension provider, the pensions regulator will pay 90%, and the trust which SJP holds will pay 10%. As far as we are concerned, whatever money is lying in your pension pot is protected for 100% completely. Yeah, we covered this. Yeah, the directors don't take salary from the company. Yes, they can still contribute as long as they take something, as long as the company makes the profit. That's fine. I'm happy to take more calls on. I know it's a very technical area on pensions. Anything you want to ask about?
I think that's enough on pensions. I think that you've given everyone some food for thought. Thanks for that. You want to talk about anything else, Shabeer? You want to move on to the next section?
Yeah, the next thing I want to talk about is life cover for the directors of the company. Yes, like I mentioned, relevant life plan, because in the financial world, that's very important, because protection is the cornerstone of everything. If you don't have protection, everything falls apart. So basically, you can take a life cover for yourself, and company pays. I know most of us have life cover for the mortgages, etc., where we pay from our pocket. Because you're directors of limited companies, you have that advantage. So you can have your cover in your names, and it's a level term, and it can cover up to the age of 75, and the company will pay for it. And Saeed will take that as an expense for the company. It's a no-brainer, actually. And many people don't know about it. That's one of the features you can do for when it comes to pension. I'm sorry, when it comes to life cover.
Shabeer, on that front, right, just a question. Someone asked me this the other day, and so I said to them, I will ask you this question.
Tell me.
Key man insurance.
Yeah.
Is that the similar sort of thing, or is it a different word for the same thing, or is it a different sort of thing altogether?
No, it's slightly different. Key man's insurance is different to relevant life plan. Relevant life plan gives you the way the benefit is calculated is different. On a relevant life plan, which is taken for the director can choose any amount arbitrarily. Yeah, you can say like usually it's about 10 to 25 times their drawings. Yeah, like you can take it. Keyman's is slightly different. Keyman's is for slightly bigger companies. So I guess most of your clients are more like one-man band. They run the company, right? So for them, relevant life plan will be more beneficial. It's cheaper as well. So you can take, depending on the age, so it can go up to 25 to 30 times of your earnings basically through the company. So that's one thing. And someone's asked the question to take whole of life. No, whole of HMRC doesn't allow whole of life through the company. That has to be taken. Whole of life is slightly different. Whole of life is more expensive. That can cost you 10 times the premium, the whole of life, because whole of life guarantees you the payment regardless of whenever that happens. But whereas any other life cover, including this relevant life plan, that will be up, the relevant life plan is up to the age of 75. So if you take it, and if you go on past 75, you just have the protection, but you won't get back the premium that you paid. In a whole of life, you get the premium, you get the lump sum. That basically whole of life is done for inheritance tax planning. Yeah, whole of life, Stephanie's asked for the question. Whole of life, we can do that. But if you, the reason you do whole of life is if there is any, let's say, inheritance tax liability in the event of death, right? See, usually the term life cover which you take is for a specific purpose. People take it up to the age of 75 so that if they die before that, the family is not financially constrained, the lifestyle is maintained, yeah? So the reason people take whole of life is if they have a large inheritance, if they're leaving a lot of capital for the assets for the next generation, if they have to pay a huge inheritance tax, we calculate. It's a very niche area. We can't just willy-nilly recommend whole of lives. I have to go through the whole scenario, understand what's the total wealth is, and what will happen to the next generation if they were to die. Then they work out. So that even if you're paying a larger premium, in most of the cases, it makes it sense to have a whole of life because that saves huge amount of inheritance tax for the next generation. First, I don't know briefly, I'll touch base with you how inheritance tax works. Yeah. So any wealth that you have in the UK, it's if you're UK domicile, your worldwide assets, not just UK assets. If you have properties, bank balances, investments, even outside UK, all that's taken into consideration for inheritance. And contrary to popular belief, people think that if I die, my children are the first beneficiary. That's not true. The first beneficiary is HMRC. Unless you pay off the inheritance tax, you don't get a probate. Yeah. So they are the first thing. So they will make every way possible to make sure that they extract the maximum in terms of inheritance tax. Yeah. What happens is, first 325,000 of your wealth is tax-free. There's no inheritance tax. Anything more than that, you pay inheritance tax. There's another thing called residence nil rate ban. What it means is if you own a property, so you have like 175,000 allowance there. So technically you have £500,000 leeway. So up to first 500,000, there's no inheritance tax. Anything more than that, your beneficiaries pay 40% tax on that. Having said that, there's no inheritance tax between spouses. Yeah, that has to be made clear because what HMRC's definition spouses is if somebody is living or cohabiting, they don't get that allowance. If a person dies, their partner will not get that relief. So if a husband dies, even if he had 10 million pounds of wealth, the whole 10 million goes to the wife with zero tax. She doesn't have to pay any tax. The tax kicks in only on second death. When the wife dies, the children, when they inherit, they start paying that tax. Yeah? So the way we do this whole of life is we calculate basically what would be the tax liability and how much the children have to pay. Accordingly, you take whole of life cover to cover that inheritance tax in the future. That's the reason why people go for whole of life policy to protect the wealth from inheritance tax implication. Yeah. If you guys, anyone have any other questions on, see, inheritance tax, as I said, it works both ways. It's not just what you have when you're passing it on to the next generation. Many times I have clients whose parents have a lot of wealth. So they might be the beneficiaries in the future. So it's very important to make sure, have their parents done the financial planning to make sure they have covered all the inheritance tax implications in the future. It's very important to look into that aspect as well. Sometimes it can be a bit delicate topic to talk to your parents about, have you discussed about inheritance tax, but it's very important. Yes, Amir has asked this question, how can you structure properties, including rental inheritance tax? See, one of the ways, if you have too much of wealth, one of the ways for you to plan inheritance tax is start gifting it to your beneficiary, the children, etc. If you gift a property, it falls off your estate after 7 years. So your children get it. So even if death happens within the 7 years, you'll pay lesser inheritance tax, besides your whole of life and all that. So if if you feel that you're going to leave a lot of wealth for the future generation, one of the ways to do is slowly start gifting wealth to the kids. But the whole idea is when you gift it, you cannot benefit from it. For example, if you have buy-to-let rental properties, when you gift it to your children, the rent has to go to them. You can't have the rent and just give the property. Then HMRC will take the properties back into your estate and they'll start taxing you inheritance tax. Or in some cases, there is a way to do it, like you set up a trust. You can have certain assets in trust. It's a more complex area that it all depends on individual circumstances. So that's one way to do that as well, to put certain assets into a trust. So when you move those assets into your trust, that falls off your estate as well. Again, the same 7-year rule will apply, but you're moving it. But what we always recommend is, if you're in your 60s, close to 60s, and you feel that you're likely to leave a lot of wealth to your kids, then it's a good way is slowly start gifting them. I mean, of course, you need to look after yourself first to make sure that you have enough income. So that's the reason, compared to all these, the pension is the only thing which sits outside inheritance tax. So let's say you have £1 million of buy-to-let properties and all that stuff, and you have 1 million in a pension, that whole 1 million is completely ring-fenced against inheritance. It's a no-brainer to build that up. So you can enjoy that pension as long as you want. And after your death, that money is passed on to the kids, and they don't form part of your estate for inheritance tax as well. The same thing applies to the relevant life plan I spoke about. That life cover is also held in a trust. In the event of death, that doesn't form part of your estate for any inheritance tax implications as such. ISAs, Donna's asked about ISA. ISA is basically, you do it from your personal account. Basically, you can't do it through the company. ISA, the investment in ISA is similar to pension. The fundamental difference is when you're contributing, you're doing it from your earned account where you already paid tax on, and there is a limitation. On an ISA, the maximum you could do per annum is 20,000, whereas in a pension, you could do up to 60,000 a year. So technically, if your company is making a lot of profit, you don't want to pay that much corporation tax to HMRC. You can technically put 60,000 each year and start saving a huge amount of tax on that. ISA, when it comes to withdrawal, ISA, there's no tax on withdrawal. Even if you make up $500,000 of ISA, you can draw the whole amount tax-free. Whereas pension, you have only tax-free for 25%, the remaining 75% you pay tax. And another difference between ISA and pension is the ISA will form part of your estate. In the event of death, that can attract, that will be inheritance tax implications there, whereas pensions won't. So they have like structural difference between both. In terms, as far as fund is concerned, the growth is exactly the same. But when it comes to extraction and tax implications, these are the differences. ISA is 100% tax-free, but it can have inheritance tax implication because it cannot be ring-fenced. Corporate financial planning side. Buy-to-let, yeah. So one of the things you could do is if you want to diversify, I mean, after having pensions, etc., you can set up a SPV from your limited company. You have your main parent company, you have a sister company, the buy-to-let, and the company can start buying the properties from that company. So you're the director of both the companies, and your parent company can loan the buy-to-let company as for deposit. We arrange for the mortgage for that. And it's a bit of a diversification. That's it. Because when you retire, the whole idea is you have income from various sources. You don't put all the eggs in one basket. So you have some from pension, some from ISA, some from rent from the buy-to-let properties, etc. So yeah, and also that makes sure that you're not leaving too much money in the bank account for the company. So if you have a lot of cash lying around, that's one way to do is to set up an SPV. So it can help you to set up a special purpose vehicle, and I can help you to finance to buy a buy-to-let property, be it a commercial. You can buy commercial properties, or you can buy houses, flats, etc. And there are certain tax advantages of holding the property in a limited company compared to holding a buy-to-let in personal names. And if you want, I can go through that. What are the benefits of buy-to-let in the limit if you have time and if you want me to, but these are the advantages of doing it.
Okay, Shabeer, it's 7:15, so I'm just bringing you conscious of time. So if you've got any more, another aspect to it, you want to bring that on, you can. You've got about 10 minutes.
Okay. Other one I want to talk about is income protection. It's called executive income protection, because most of your clients are like sort of one-man band. They run the business, right? They represent the business. So what happens if they fall ill, if they had an accident, God forbid, the doctor says they can't work for the next 2-3 years. So what's happening to the family income, etc. So what we do is, in which case we set up something called executive income protection, where the company will pay for it, the premium, and you treat that as an expense. And your directors or family gets the regular income. So even if you're not working for a longer period, you get your income so that your lifestyle is not disturbed. So that's one way of looking at it. It's a no-brainer. Normally people take income protection from the personal account because you guys are directors of the company. That gives an added benefit. Besides saving corporation tax, you're also having that sort of a cover for yourself. Because that's very important, isn't it? See, chances of somebody dying is very slim, but chances of somebody having an accident or not being able to work for a longer period can happen to any of us. We don't know what's around the corner. So having that sort of executive income protection makes sure that you have that regular flow of income, regardless of whether you work or not. Okay, on the corporate side of things. Yeah. And private medical insurance, again, I said, but private medical insurance is considered as a benefit in kind. You get this added benefit. Your company pays for the private medical insurance, so you can take it for yourself and your families. So they have like various benefits. So it's advantages. You don't need to wait for your GP to give you an appointment, etc. You go privately and you have that sort of a comfort. But then Side will take that as a benefit in kind. So that's the only difference. Unlike others, private medical insurance will have that benefit in kind. A small amount of tax, but still worth it if somebody is interested in doing that. See, off late, we are seeing huge growth in the private medical insurance sector now because of all this chaos in the NHS. People, they prefer to have, if they have that sort of comfort, enough money the company is making, they would like to go for the private medical insurance, especially with people who have younger children. They don't want to depend on NHS for the treatment. And
Shabeer, I've got one question that's come through. The question is, they've sent it to me. SIPs. How does SIPs fit into a limited company?
yeah, SIPs, basically, it's only what I call it. It's a different product. It's all retirement account. Basically, it's a pension account. SIPs is it's for more, I would say, experienced and niche investors. They choose their own investment funds, etc., to hold it in the pension. The bottom line is it's the same. So what we do is, in terms of pension, we choose our own funds. We have a portfolio which is held in a pension pot. In a SIP, some clients want to have the flexibility of having their own sort of fund. Actually, you can even do things like properties. You can buy commercial properties and hold it in the pension as well. That's possible. That's a SIP basically. So you can buy a commercial property, and then you can even take a mortgage against the property and then hold it under your pension. Your limited company, your pension holds the whole commercial property as a pension. That's a very complex area that I need the whole session to cover. That's SIP, where you hold commercial properties into a pension. You can do that. It has its own pros and cons, but there are a lot of people who do that as a commercial property. So a lot of people like it. And the advantage in that those properties, if you hold a commercial property in a pension, there's no tax at all. Any rent that you get, it goes back into the pension pot and you don't pay any tax on it.
Shabeer, thank you for being with us today. Now, just for the benefit of everyone here today, like, you see, what we're talking about today is a highly regulated matter. So That's why when, as an accountant, we advise you on taxes and etc. But when it comes to pensions and investments, we have to have someone who's an independent financial advisor, which is why we put you in touch with people like Shabeer to, to advise you, etc. Because it is highly regulated and we are not allowed to give you our opinions and advice. We have to put you in touch with someone who's a independent financial advisor, and that's what Shabeer is. You open the doors for a number of things, and we will invite you back, Shabeer, another time to talk about a bit more detail about some of the aspects that some people would like to go to. I'd like to thank you for your time, and please, feel free to share your contact details. If anyone's got any specific questions, I don't mind. They can contact Shabeer directly, and therefore you can contact him, because there will be some of you will need a one-to-one personal invitation from Shabeer. You'll need to go through. You'll need to have, because it's your circumstances. Everyone's circumstances are different. And one of the things that Shabeer does offer is that he will sit down with you, whether it's via Zoom or he comes to see you, etc., depending on where you're located. He will then talk to you about your specific circumstances, because everyone's circumstances are different. And therefore, what's tailored to your solution has to be perfect for your thing. It's not one generic thing that's going to fit everyone here today, because a lot of it's going to depend on your wealth, your age, also a little bit about your risk appetite, etc. So all of those things come into place, and that's where Shabeer will sit down with you. He's obviously told you he's a partner of St. James Place, one of the biggest wealth management companies in the UK. So his details are on the screen. Feel free to take a screenshot of them. And if anyone wants anything else, you can contact me. I'll be more than happy to pass his details on to you. If there's anything I can help you with, you've got my details anyway, most of you. So feel free to contact me, anytime, and we'll talk then. It's coming to an end of today's session. Shabeer, you want to say anything? You want to wrap it up?
No, basically what I've said is all very, very generic. When I sit down with you one-to-one, like rightly Said said, that's when you'll know you have a proper, we use something called 100-year planning tool, financial planning tool. That gives you full input into what's happening, your personalized circumstances at all. Yeah, this at least it gives you a broad overview of pensions and what sort of planning you can do for your business and for yourselves as well. So feel free to email me or call me if you have any questions. Happy to, you can jot down my email address, or you can ask Said as well. If you have any specific query or you want to have a chat with me, I'm happy to go through that with you.
Okay, guys, thank you for everyone for turning up today and for spending this hour after work. I know for some of you, most of you, it's been a very, very long day. So thank you for turning up. Special thank you for Shabeer for taking his time, your valuable time to take care and share it with everyone here today. We will invite you back for some other things. So guys, keep a lookout for these webinars. We do them for your benefit. And if there's any questions that we missed out, feel free to contact me or Shabeer, and I'll get them to Shabeer, and he'll be able to guide you with those. Thank you again.
Okay, last question, yeah. If any, I'm based in London. If any of your clients are in London, happy to see them face to face as well. If someone wants to have a chat, I mean, there's no fee on it. We don't charge anything for any consultation or anything. I mean, like, I'm happy to do that, just to let you know.
Thank you. Grateful, Shabeer. Obviously, he's based in London, but he deals with clients up and down the country. I know a couple of our clients are in the right in the northeast. Shabeer's been dealing with them, so it's a long distance from almost Newcastle way to where he's based. But he's been dealing with some of my clients in Newcastle, so absolutely. So he covers the whole of the UK, not a problem at all. His contact details are on there. So thank you again, everyone, for turning up today. And finally, thank you, Shabeer, for I hope you found it useful. That's what these webinars are all about. It's all about giving you information. And it's good to connect to and see so many of you here today. Thank you. Okay, we'll call it.
Thank you, Said. Thanks, everybody, for listening. And please feel free to contact me if you need any questions. Yeah, thank you.
Right, guys, I'm going to close it now. Thank you. Bye. See you next time.